In this week's update, inflation is heating up, but that's not unexpected. How will markets respond facing an avalanche of headwinds and rotation away from growth? My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. Let's start with a market perspective because things have changed back again to where we were only 2 or 3 weeks ago. There seemed to be a fairly emphatic rotation from defensive back to aggressive once we had the lows in late March. And just in the last week, the market's just been overwhelmed by the inflation numbers, by the Fed rhetoric that has just ramped up enormously, and it's just absolutely spooked the market. And there's been literally a stampede out of tech stocks and out of growth stocks. So we're back to where we were in March, and the very short-term outlook is not all that bright for the aggressive sectors of the market. However, having said that, and there are many logical headwinds, and I'm sure all of us can sit down and write out a list of 8 or 10 major things that would be bad for stocks. But at the end of the day, there really is no alternative to stocks. There just isn't. Real yields remain strongly negative, so that's the nominal yield less inflation. So we're still strongly negative. So you don't want to be in cash. You're just going to get murdered in cash. Bonds are definitely not it, because bonds are being sold off. And I've been saying this for 6 or 12 months now. This is a really bad time to be looking to the bond market for a return. You're almost certainly going to be locking in a lower interest rate than you otherwise would, and you're probably going to suffer some capital loss as well. So bonds definitely aren't it. Investors still seem shy on gold and cryptocurrencies. Gold may be a bit of a glimmer, but cryptocurrencies are definitely proving that they're not a counter-cyclical defensive asset. As gold was often considered to be. Cryptos are being sold off whenever the aggressive sectors of the market are sold off, so there's no safe haven there. So there is no alternative to stocks. However, we're seeing these massive rotations, first of all from growth to value, and then back to growth, and now back to value again. And that's all happened in the last 4 months. So it's these rotations that are proving to be very difficult to negotiate, and why your game plan just needs to be so crystal clear. There certainly are parts of the market that are doing well, and particularly in Australia. I'm finding personally the US is hard work. It just really is hard work. But the Australian opportunities are extremely buoyant. And, I'm feeling extremely comfortable with the Australian market, but certainly not the US. The risk, of course, that we've got is the central bank policy error, that they feel the need as the inflation numbers rise faster than what was expected. The Fed feels the need to do half-point interest rate rises, and maybe several of them. And it's very real that they could bring on a recession because they just fight inflation too quickly. And it's still quite possible that inflation will moderate once we get into May. And I've been saying that now for 6 months, because the equivalent numbers in 2021 are going to be showing increasing inflation. So on a comparative basis, inflation is going to look to be moderating. And as soon as that happens, I think then that takes the pressure off the Fed. It's just going to be a photo finish as to whether the Fed really starts to get aggressive too soon. So I think that's the biggest risk that markets face at the moment. But having said all that, I talked about how I'm feeling extremely comfortable with the Australian market. And it's largely because commodity stocks have just done so incredibly well, and we've just got such an absolute smorgasbord of opportunities that really do look exceedingly compelling, and many of them are trending higher. So commodity prices, are they bulletproof? look, years of underinvestment in just about everything, whether it's energy or copper or nickel or whatever it might be, virtually ensures that we're going to have a supply deficit in many commodities. And you can add in agricultural commodities in there as well. So you can't just switch those things around quickly. If you've had years and years of underinvestment, it takes many years to discover and do the feasibility studies and get the offtake agreements and raise the capital and construct the mines. You just can't switch it on quickly. And so it would appear fairly likely that we're going to have years and years of supply-demand deficit. And that's just got to be positive for commodity prices. So we were already heading towards a tight situation anyway because of the underinvestment. But now we've got Ukraine and Russia, which are just such major exporters. And it's really opened my eyes as to just how many commodities that Ukraine and Russia are very, very significant global exporters of. And so that's just made an already tight situation worse. Let's turn to American stocks. The S&P ended up falling 1.3% for the week. But look, the S&P is quite misleading if you are an investor in technology stocks, because technology did a lot worse than that. So the S&P, the defensive parts of the S&P helped it to certainly a better result, and the Nasdaq was down by at least double that, maybe even closer to triple that across the week. Now, the good news is, from a technical perspective, that the S&P is just holding the 200-day moving average just by the skin of its teeth, but it's still there. But there really has been quite an emphatic move away from growth and consumer discretionary stocks, as we'll see when we look at the spread charts in a minute. The US dollar managed to push a little bit higher, obviously, with the expectations that the Fed is going to be more aggressive on rates. That pushed the 10-year yield up. It's now at 2.72. But despite the fact that that short-term or medium-term rates have gone up, longer-term rates are also going up as well. And so we actually got the 10-2 curve actually going from negative, so inversion, back onto the positive. So that's rebounded quite nicely. Now, we also saw the VIX spike to 25 on, I think it was Thursday, intraday. And whilst the market finished a bit negative last night, or on Friday night, the VIX still finished around about 21.6. So it's just sort of line ball. I think above 20, the market's nervous. Below 20, the market's not so nervous. So it's a little bit indeterminate there. All right, let's take a look at some charts. So this is the S&P, and you'd be forgiven if you looked at this chart in thinking, well, what's the problem with the market? It's just consolidating this huge run that we had up here. But we've got certainly two different halves to this market. So if we look at the Nasdaq, for instance, so look at the S&P, the 200-day is still rising slightly, and the price has been fluctuating above and below it. But the shorter-term moving averages, you can see, are just starting to turn up again. But if you look at the Nasdaq, sorry, I don't have the Nasdaq queued up. Let me just put that one in there. Okay, so there's the Nasdaq. So you can see clearly that we've spent nearly the entire time below the 200-day, and we had this very strong rally off the mid-March reversal, but it only made it to the 200-day, and then it's been rejected again from that level. So the Nasdaq is certainly underperforming significantly, and if we look at the important spread charts, this is the Nasdaq versus the S&P. We broke support and then rallied very strongly. And last weekend when I reported on this, it really did look extremely good for growth stocks. But they've just been overwhelmed by the Fed, and almost every day someone in the Fed was coming out and making statements about how interest rates were going to have to go up more than what they previously anticipated. So that really has punched a very, very sharp hole in the aggressive sectors of the market. If we look at the small cap growth versus small cap value, not a lot of change here. We're seeing, the growth side of things cooling off a little bit, nothing too dramatic. But it's when you get to the Russell 1000 growth versus 1000 value, you can see just how dramatic that was. It was as sharp as we saw back here in early January when the big correction really started. So I can't put my hand on my heart and tell you that we're not going to see a lower low in this spread, and perhaps the market below the mid-March lows as well. I'm not predicting that's going to happen. I wouldn't rule it out at this stage. Such has been the emphatic nature of this pullback during the week. And this is consumer discretionary versus consumer staples. Another nail in the coffin, if you like, for the bullish brigade in the market. This is not really what you want to see for a bullish market. So I think until we get a bit more clarity, earnings season starts in the US next week. That might save the market if there are some good earnings reports. But it's certainly looking a bit shaky otherwise. Turning now to Aussie stocks, our dollar was a bit lower, 73.95. Our index only finished down just a fraction across the week, thanks to continued strength in mining stocks and also in utilities as well. Continue to do really well. So that's a very unusual mix to see mining stocks and utilities leading the way at the same time. And of course, smaller miners are still having their powerful bursts, and there's just some, highly encouraging opportunities in that space. All right, let's take a look at the currencies now. In fact, before we do that, let me just look at, this is the 10-year Treasury. So you can see let me just put that over the last 5 days. And you can see quite a consistent move. We went from 2.4 and finished above 2.7 just across the week. And if we go out a bit further and look over the last 3 months, you can see it really has started to take off very sharply, and that's what's puncturing the growth stocks. And if we look at the ratio between the 10-year and the 2-year, or the difference between the 10-year and the 2-year, you can see we've rebounded quite strongly. We were slightly negative last week, but we ended up at 0.19. So that's quite a sharp rebound on that spread as well. Okay, so turning now to the Australian market, if we look at the ASX 200, certainly saved by materials, which were quite strong, but also energy did extremely well in Australia, and so did utilities. So a pretty good week for those sections in the Australian market. Now, if we look at the US dollar gold price, this is the daily, and you can see we've definitely got a triangle that's formed up here. And despite the fact that the US dollar moved higher, a little bit higher on Friday night, gold did very well and finished up at 1948. So it's just a little bit of a glimmer with gold. It really needs to get, in my view, get up around above 1970. But if we look at GDX in a minute, or GDXJ in just a minute, you'll see that the small miners continue to outperform. So there's the weekly chart. We're still in this consolidation, but I wouldn't write off another move to the upside. Silver, not really outperforming gold at this stage. But if we go to GDX and GDXJ, you can see we've consolidated high right around this resistance level, It's not going to take much to get a breakout, and I think you might see a surge of investment in gold stocks. But they've been extremely difficult to catch. That's for sure. So just summarising, gold up $23, just under 1950, and GDXJ, we're seeing some outperformance there. And I'll just go back to that chart, that spread. So this, that's the one I'm after. So this is the miners, GDX versus gold versus GLD, which is the ETF tracking gold. You can see this has been a very concerted move from the end of January. So we've seen a significant outperformance by gold stocks that's really starting to take on a more significant dimension. And I'm always looking for outperformance by the gold stocks, particularly the upside, because it's often the gold stocks, the miners, are going to be outperforming the gold, the underlying metal itself. So that's a positive sign. Turning to other commodities, copper was up just a couple of cents. Nickel, however, was up again, up to 15.48. So it's continuing to hang on to a good slice of those gains. And both of those outcomes are pretty impressive considering that the US dollar was stronger. Now, crude oil fell again. It was just under the 100 last week. It's down to 98. But the longer term outlook, given the underinvestment and the continuing demand situation, the outlook's got to be higher for crude oil, you would think. Now, I've always been very reluctant in this area because it's always been so geopolitical for me. I've never really had the confidence that I wasn't going to get sideswiped by some geopolitical decision. But I think, notwithstanding those, and they're still going to happen for sure, notwithstanding that, I just think the supply-demand situation for oil, you've probably got to expect oil to go higher in the future. And already the energy sector is outperforming. And if you look at the fact that crude oil was down throughout last week, and then we look at the US energy index, which is XLE, look at what XLE did on Friday night. And look at the accumulation that's happening intraday. So the fact that oil was down for the week, but the energy sector had quite a strong week and finished well. This is certainly one of the bright spots in the US market. There's the spot copper chart. So we're in a medium-term uptrend there. Nickel bouncing off the $13 lows. And so wrapping everything up, there's not much question we're in a commodity boom, and it's pretty hard to see that getting derailed. It would take a serious global recession, and even then I'm not so sure that it will do it, because there is just such an incredible emphasis on electrification and decarbonisation that you just can't see the demand. Most of the demand is not coming from industrial sources. It's coming from the build out of renewables and electric vehicles that's driving these booms. So as a consequence, your portfolio composition doesn't need to be the same old diversification for the sake of it, because we're going to see as a very significant divergence in the market. We're going to have sectors that are doing extremely well and sectors that are really going to struggle. So the same old is just not going to cut it, and not even close. Portfolio analyst last week, actually, it was the week for taking stock, which is I do once a month, which is a really strongly focused learning forum. So that was what we did last week in Portfolio Analyst. That's it for this week. There's more detail on the website. There's my email address, and I'll be back with you next Sunday. Cheers.